The bottom is in, at least that's what Reuters is reporting. After a 37% crash from 121 to 78, the worst collapse in 46 years, silver just staged a violent reversal. We hit $78.20 on the intraday low, then rocketed to $82. That's a 5% bounce in less than 24 hours after a month of absolute carnage. And it's not just technical analysts and YouTube traders calling the bottom. Reuters, one of the largest financial news agencies in the world, just published a piece titled "Silver Rebound Signals End of Historic Crash." They're citing institutional buyers returning, physical demand surging, and technical support holding at critical levels. But here's the question that is going to determine whether you make money or lose everything in the next 30 days. Is the crash really over? Is this the start of the rally back to $100, $120, maybe even the $150 that Citibank is projecting? Or is this just another bear market trap designed to lure in buyers before the final capitulation drop to $70 or lower? Because what happens in the next 48 to 72 hours will separate those who catch the bottom from those who get destroyed trying, and the signals are contradictory. The fundamentals are screaming by, the technicals are flashing warning signs, and the manipulation is still very much alive. If you want the complete breakdown, what Reuters is actually saying, what the data is showing, and the exact strategy for navigating what comes next, hit that like button, share this with someone who needs clarity, and let's dissect the truth. I'm Asian Guy, and this is the post-crash analysis they don't want you to see. Let me start by telling you exactly what Reuters published, because the details matter. The article dropped yesterday afternoon, titled "Silver Stages Sharp Rebound." After a historic 37% crash, analysts see bottom forming. Here's a direct quote. Silver prices rebounded sharply from a 46-year low, climbing back above $82 per ounce after touching $78 earlier in the week. The recovery comes as institutional buyers return to the market and physical demand in Asia remains resilient despite the paper market collapse. Technical analysts suggest the worst may be over. They interviewed 3 separate analysts. First, a commodities strategist from Standard Chartered who said, "The selling pressure appears exhausted. We're seeing capitulation indicators flashing across multiple timeframes. The bounce from $78 is likely the beginning of a multi-week recovery." Second, a precious metals analyst from TD Securities who stated, "Physical premiums in Shanghai have held firm throughout the crash, suggesting the decline was driven by paper liquidation rather than fundamental weakness. We expect prices to stabilize in the $80 and $85 range before testing higher levels." Third, an independent technical analyst who noted, "The hammer reversal candle on Thursday combined with the bullish engulfing pattern on Friday creates a textbook bottom formation. If $78 holds as support, the next move targets $90 under $95. Reuters also highlighted the delivery data. COMEX silver delivery notices for February surged to 12.8 million ounces, the highest level in 6 months, indicating strong physical demand despite the price collapse. This isn't some random blog post or social media hype. This is Reuters, an institutional news source that banks, hedge funds, and sovereign wealth funds rely on. When they publish an article calling the bottom, it carries weight, it influences sentiment, it moves capital. But here's what you need to understand. Reuters reporting that analysts see a bottom forming doesn't mean the bottom is definitively in. It means the narrative is shifting. Institutions are positioning, and you need to decide if you're early to the reversal or late to the trap. Let me lay out the bullish case first. Here's all the evidence that supports the idea that 78 was the bottom, and we're beginning the recovery that takes us back to 100 plus. Evidence 1, the $78 support held perfectly. This level corresponds to the 50-week moving average, previous consolidation support from months ago, and the 38.2% Fibonacci retracement of the entire rally from 18 to 121. 3 major technical indicators converged at exactly $70. We tagged it, rejected lower, and reversed. That's not coincidence. That's where major institutional buying kicked in. Evidence 2. The reversal candle pattern is textbook. Thursday's daily candle was a hammer. Long lower wick showing rejection of lower prices, small body showing indecision at the highs. Friday's candle was a bullish engulfing, opening below Thursday's close, rallying throughout the session, closing above Thursday's high. These are the 2 most reliable reversal patterns in technical analysis, and we got them both in sequence. Evidence 3. Volume spiked on the reversal. The crash from $100 to $78 happened on decreasing volume, a sign of exhaustion selling. The bounce from $78 to $82 happened on increasing volume, a sign of institutional accumulation. In healthy reversals, buying volume exceeds selling volume at the bottom. We're seeing that. Evidence 4, Shanghai premium remains at historic highs. As I'm recording this, Shanghai spot silver is at $119.80. COMEX is at $82.10. That's a $37.70 premium of 45.9% markup. During the entire crash, this premium never compressed below 35s. It actually widened at the lows to 41 plus when COMEX hit 78. Physical buyers in China didn't panic, didn't dump, didn't follow the paper price down. They held firm and increased bids. That's the strongest possible signal that the crash was paper manipulation, not fundamental weakness. Evidence 5, delivery demand is accelerating, not declining. February COMEX delivery notices hit 12.8 million ounces. That's up from 11.2 million last week, up from 9.4 million the week before. Reuters specifically highlighted this in their article. Despite the crash, physical buyers are demanding more metal, not less. Wells Fargo, JP Morgan, HSBC, Macquarie, all frantically issuing and stopping deliveries. That's physical stress, not physical weakness. Evidence 6, COMEX registered inventories continue draining. We're now at 36.2 million ounces, down from 40 plus million just weeks ago. At the current delivery rate of 12.8 million ounces per month, COMEX has less than 3 months of deliverable supply remaining. The physical drain didn't stop during the crash, it accelerated. Evidence 7, RSI and momentum indicators show bullish divergence. Price made a lower low at $78 compared to the previous low at 85, but RSI made a higher low. It didn't go as oversold. That's bullish divergence, a classic signal that selling momentum is weakening and a reversal is imminent. All of this supports the Reuters narrative that the bottom is in and the comeback is starting. Now, let me give you the bear case, because despite what Reuters is reporting and what the reversal pattern looks like, there's compelling evidence that this bounce is temporary and we're heading lower. Evidence 1, we're still in a defined downtrend. The 50-day moving average is at 95. The 100-day is at 88. The 200-day is at 83. We are currently at 82s, which means we're still below every major moving average except the 200-day, which we're right at. In technical analysis, the trend is your friend, and the trend is down until we reclaim these averages with conviction. Evidence 2, the volume on the bounce is good but not exceptional. While it's true that volume increased on the reversal, it's not at the levels you typically see at major bottoms. Compare this to the March 2020 COVID crash. When silver bottomed at $12, the volume on the reversal day was 3.4x normal. Here, we're seeing maybe 1.5, 2x normal. That suggests short covering and opportunistic buying, not institutional capitulation and major accumulation. Evidence 3, we haven't reclaimed any breakdown levels. Silver broke down from $110, then $100, then $95, then $90. For the reversal to be confirmed, we need to reclaim at least one of these levels. We're at $82. We haven't even gotten back to $85 yet. In bear markets, failed rallies are the norm. We bounce to resistance, fail, make lower lows. That pattern is still intact. Evidence 4, government shutdown risk is unresolved and escalating. Polymarket odds for a shutdown by January 31st are now at 91%. That's tomorrow. If it happens, the immediate market reaction will be risk off. Stocks down, VIX up, dollar strength, precious metals sold. We could see silver gap down Monday morning to $79 or $80, retest the lows, and potentially break through to $76, $75. Evidence 5. The macro environment is deteriorating rapidly. The S&P 500 just broke major support. The Nasdaq is down 8% from highs. Corporate credit spreads are widening. Yield curves are flattening. These are signs of economic stress and risk-off positioning. In the early stages of market crashes, everything gets liquidated, including safe havens like gold and silver. Only later, after the initial panic, do safe haven flows return. Evidence 6. The bounce is exactly where you'd expect a bear trap. Look at the Fibonacci levels. A 23.6% retracement of the crash from 121 to 78 would be 88. A 38.2% retracement would be 94. We're at 82, which is barely off the lows. Bear market rallies typically retrace 30-50% before rolling over. If this is a bear trap, we rally to $88, $92, trap bulls, then crash through $78 to $72 to $70. Evidence 7. Seasonal patterns are bearish. January, February is historically weak for silver. March, April is when strength typically returns. We're still in the seasonally weak period. The bounce could be a technical relief rally within a larger seasonal decline. All of this suggests that Reuters might be early in calling the bottom. The comeback might be premature, and the real bottom could still be ahead at $75, $70 or lower. Here's what you need to understand about the Reuters article. They're not telling you the bottom is definitively in. They're reporting that analysts see a bottom forming. That's very different. Reuters is in the business of reporting market sentiment and analyst opinions. When 3 institutional analysts tell them the bottom looks like it's in, they publish it. But analyst opinions are wrong all the time. Bottoms that appear to be forming fail constantly. What Reuters is actually doing, intentionally or not, is shaping sentiment. When institutional readers see that article, it influences positioning. Some funds that were underweight silver might start buying. Some traders who were short might start covering. The article itself becomes a catalyst for the bounce it's reporting on. This is called reflexivity. The narrative influences the reality. If enough people believe the bottom is in because Reuters said analysts think so, they start buying. That buying creates the bounce. The bounce confirms the narrative. And the cycle continues until it doesn't. But here's the critical insight. Reuters articles calling market bottoms or tops have a mixed track record. Sometimes they're right. Sometimes they're catastrophically wrong. So the question isn't, what is Reuters reporting? The question is, what is the actual data showing, regardless of narrative? Let me give you the 3 specific catalysts that will resolve in the next 48-72 hours and determine whether Reuters is right or wrong about this comeback. Catalyst 1, government shutdown deadline, January 31st, tomorrow. If a deal is reached and the shutdown is avoided, that's immediately bullish. Risk-on sentiment returns. Stocks rally. Silver could pop to $85, $88 on relief. The Reuters narrative gets validated. If the shutdown happens, we get immediate risk-off. Stocks gap down. VIX spikes. Dollar rips. Silver could gap down to $79, $80, retest the lows and potentially break to $76, $70. The Reuters narrative gets invalidated. Watch the headlines tonight and tomorrow morning. The shutdown vote is the single biggest short-term catalyst. Catalyst 2. Comics delivery data. Update, Monday morning. Fresh delivery intentions for February will be published Monday before the market opens. If deliveries jump from 12.8 million to 15 million ounces, that confirms physical demand is intensifying despite the crash. Bullish. Validates Reuters. If deliveries drop back to 11 million, it suggests the 12.8 million was a temporary spike and physical demand is normalizing. Bearish. Invalidates Reuters. Check the CME Group website Monday morning at 7:30 a.m. EST for the data release. Catalyst 3. The $83, $85 resistance zone test. This week. The 200-day moving average is at $83. We're trading right at it now. Former support at $85 is now resistance. If we can break through $83 to $85 on strong volume and hold above, that's technical confirmation of a trend change. Next targets would be $88, $90. If we get rejected at $83 or $85, that creates a lower high. We would then likely retest $78 or break lower. The Reuters bottom call would be premature. Watch Monday and Tuesday's price action. If we open strong and push through $84, $85, the comeback is real. If we stall or reverse at $83, it's a trap. Throughout all of this volatility and conflicting signals, you have one reliable indicator that cuts through the noise, the Shanghai Premium. Current level, 37.70, a 45.9% markup. As long as this stays above $35, the physical market is screaming shortage and the crash is paper manipulation. Here's how to use it. If the premium widens from $38 to $42 this week, extremely bullish. Physical buyers are bidding more aggressively. They're not waiting for lower prices. They're panic buying at any price. This validates Reuters and suggests $78 was the bottom. If the premium holds steady at $35, $40, neutral to bullish, physical market remains tight but not intensifying. We're in a consolidation phase. Could go either way depending on the 3 catalysts. If the premium compresses below $35 to $25, $30, bearish. Physical demand is softening. Real selling is happening in China, not just paper games in New York. Reuters is wrong. The bounce is a trap, and we're heading to $75 or lower. Track this daily. Shanghai Futures Exchange silver price, convert UN to USD, minus COMEX front month futures. The spread is your truth detector. Let me give you the precise entry and exit strategy for both the bullish and bearish scenarios. Bullish scenario. Reuters is right. Comeback is real. Entry. If we break and hold above $84 on Monday or Tuesday with strong volume, enter long at $84.20, $84.50. Your stop is below the $78 low at $77.50. Risk, $6.70 per ounce. Target 1, $90. Previous support turned resistance. Take 25% profit. Target 2, $95. Major breakdown level. Take 30% profit. Target 3, $105. Psychological resistance. Take 25% profit. Target 4, let final 20% run to 120 plus if the rally extends. Position sizing, use 50% of normal size initially. Add another 25% if we break $90. Add final 25% if we break $100. Bearish scenario. Reuters is wrong. This is a trap. Entry. If we get rejected at 83, 85 and roll over, or if government shutdown triggers a gap down, wait for confirmation. Don't short the bounce blindly. If we break below $78 on volume, enter short at $77.50. Stop above the bounce high at $83. Risk $550. Target $175. Psychological support. Take 30% profit. Target 2, $72. 200-week MMA. Take 40% profit. Target 3, $68.70. Major capitulation zone. Take final 30%. Alternatively, if bearish but don't want to short, just wait. Let it break $78, flush to $75, $72. Then look for another reversal pattern at lower levels for a long entry. The key rule, don't fight the tape. If $85 breaks to the upside, don't stay short. If $78 breaks to the downside, don't stay long. Follow the price action, not your bias. Here's where we stand. 3 key takeaways. Number 1, Reuters confirms the comeback narrative with institutional analysts, calling the bottom at 78. The technical reversal pattern is legitimate. Hammer candle, bullish engulfing, volume spike. The 45.9% Shanghai premium proves physical demand is still extreme. Delivery intentions at 12.8 million ounces confirm physical stress, but Reuters calling a bottom does not make it true. It shapes sentiment that can become self-fulfilling or catastrophically wrong. Number 2, we're at a critical decision point. Bullish case, $78 held, reversal confirmed, rally to 90 plus begins. Bearish case, this is a 30-40% bear market retrace before another leg down to $75, $70. The evidence is mixed. We need confirmation from the 3 catalysts. Number 3, the next 48, 72 hours are everything. Government shutdown vote tomorrow. COMEX delivery data Monday. $83, $85 resistance test this week. If all 3 confirm bullish, Reuters is right and the comeback is real. If any breaks bearish, we retest $70 or go lower. The tension that remains, Reuters says the comeback is confirmed. Analysts see the bottom at $78. The technical reversal pattern is textbook. The Shanghai premium is 46%, the highest in history. Delivery demand is at 12.8 million ounces and rising. But we're still below all moving averages. The government shutdown could trigger another flush tomorrow. The macro environment is risk-off. Volume on the bounce is good, but not exceptional. We haven't reclaimed any breakdown levels yet. Is the crash over? Is $78 the generational buying opportunity that leads to $120, $150, $200? Or is this the classic bear trap before the final capitulation to $70? Do your own research. Reuters is reporting sentiment, not certainty. Analysts are often wrong. Markets don't care about narratives. They care about supply and demand, flows and positioning. The bounce from $78 to $82 is real. The reversal pattern exists, but confirmation is needed. Watch the 3 catalysts. Monitor the Shanghai premium. Trade the price action, not the headlines. If Reuters is right, you'll know by Wednesday. If they're wrong, you'll know by Monday. Either way, protect your capital and execute with discipline. This is Asian Guy. The comeback is being called. The data will confirm or deny. Trade what you see, not what you hope. I'll see you in the next one.